Suppose tomorrow's forecast says 30 degrees Celsius, which is 86 Fahrenheit. Yesterday, it said 27 Celsius, or 80.6 Fahrenheit. You shrug. Maybe it means you'll choose a different shirt. But for someone else, that tiny change just moved millions of dollars. This temperature swing can mean drought warnings in Iowa, surging natural gas prices in Germany, or missed retail sales in Tokyo. But how can something so small have such a big impact? To answer that, we have to talk about chaos theory, commodity markets, and the strange, invisible wires that connect the atmosphere to your pension fund. It's easy to think of weather as background noise. But to a huge part of the global economy, it's the main character. The agriculture sector, worth over $5 trillion, lives and dies by the sky. If a heat wave bakes the US Midwest, corn futures spike. Energy markets react instantly. Higher temperatures mean more air conditioning. That means more electricity demand. That means higher natural gas prices, sometimes by 10% in a single day. In insurance, a thunderstorm can trigger $100 million in claims. And in retail, something as simple as cooler than expected summer weather can kill swimsuit sales, throwing off entire quarterly forecasts. Weather is a first-order driver of risk, revenue, and investment. And the better the forecast, the more valuable it becomes. But here's the problem. Weather is governed by deterministic chaos. That means it follows precise rules, physics, fluid dynamics, thermodynamics, but is still unpredictable because it's incredibly sensitive to tiny changes. This is the essence of chaos theory. In the 1960s, meteorologist Edward Lorenz ran a simulation, rounded a value by just 0.0001, and the weather pattern changed completely. He coined the metaphor. A butterfly flapping its wings in Brazil can set off a tornado in Texas. In practical terms, a 0.1 degrees Celsius change in sea temperature over the Pacific can shift rainfall across North America. A dusty wind over the Sahara can delay a hurricane in the Atlantic. A cloud formation you can't see yet can flip the forecast by tomorrow morning. So, when that app says 30 degrees Celsius instead of 27, what we see is the visible output of an invisible, ever-evolving global system. And traders are watching every decimal. Commodity traders used to rely on farmer gossip and weather radios. Today, they subscribe to premium forecast data from NOAA, the ECMWF, and private satellite firms. Because reacting first to a weather model upgrade gives them an edge, there are weather derivatives, literal financial contracts based on temperature or rainfall. They let utilities and farmers hedge against mild winters, cold summers, or storms. And in high-frequency trading, some firms run machine learning models that process petabytes of atmospheric data in real time. But not all forecasts agree. In fact, model divergence is a market signal in itself. For example, one model might predict 32 degrees, while another might show 38. That 6 degrees difference could mean 10% less corn yield, 20% more air conditioning demand, and a $200 million price swing in futures contracts. So traders look at confidence intervals and meteorological volatility, just like they look at earnings estimates or GDP uncertainty. And that creates a cascade effect. The weather affects the market, investors respond to model updates, which in turn affects asset flows and hedging behavior. Suddenly, the economy becomes meteorologically entangled. Let's look at 3 real-world examples. First, the Texas freeze in February 2021. A polar vortex plunged temperatures below -10 degrees Celsius. Natural gas pipelines froze, wind turbines failed. Electricity prices surged 300 times. The total Texas electricity costs on February 16 alone was greater than in all of the previous year. Second, the European heatwave in 2022. High temperatures in France and Germany shattered records. River levels dropped, halting cargo on the Rhine. Cooling demand sent energy prices to new highs. Inflation was amplified and damages to agriculture and infrastructure reached billions of euros. Third, Russia's drought in 2010. Crops failed across Russia. The government banned wheat exports. Global food prices soared, especially in import-reliant countries like Egypt. In fact, many link this shock to the economic instability that contributed to the Arab Spring. Each case began with a forecast. Each ended with market volatility and geopolitical consequences. In financial terms, weather is not an idiosyncratic risk, something you can diversify away. It's a systemic risk, impossible to avoid. And climate change is amplifying that. More extreme weather means more forecast volatility. More uncertainty means more hedging, more speculation, and greater exposure to tail risks. Events with low probability but high potential loss. The insurance industry already feels it. The average cost of natural disasters has quadrupled since 1980. Reinsurance companies now bake climate models into premium calculations. And, in some regions, weather is already considered uninsurable. The frontier now is hyper-local forecasting, using drones, laser measurements, and AI to predict micro-weather. Wall Street is watching. Imagine a fund shorting oil because cloud cover lowers solar output in Texas. Or a pension fund adjusting inflation expectations based on hurricane forecasts. Or even your robot advisor rebalancing your portfolio after a rainfall alert in China. It's not science fiction. It's the new weather economy. A small forecast change is a signal, a tiny ripple in a chaotic system. That ripple changes models, models change markets, markets move money, and money changes the world. Every time you open your weather app, you're glimpsing at a system far bigger than you see. Because in the end, finance and meteorology are both about prediction under uncertainty. And tomorrow's weather? It's the perfect reminder that a small change in input can shift everything in output.